Welcome back to the Deep Dive. I'm John.
And I'm Wendy. We're part of the team here at WeWire that puts together the Stay Wired weekly recap.
And this time, we're doing a deep dive into something really fundamental that's changing in global finance. It affects, well, pretty much everyone involved in international trade.
It really does. Think about this. Africa's e-commerce market, just as one example, hit $30 billion in 2023. That's already huge, but it's projected to soar to maybe $75 billion by 2027.
Wow, that's incredible growth.
It is. And behind all that growth, there's a basic but massive challenge. How do you actually pay for goods moving across borders efficiently and affordably?
Yeah, and for decades, the answer has largely been the same. The SWIFT system, it was launched way back in 1973, connects over 11,000 banks and financial institutions globally across 200 countries.
And the scale is just mind-boggling. SWIFT's own 2024 report says it handles something like $150 trillion in cross-border payments every year. Trillion.
It's basically the underlying plumbing for global trade, has been for 50 years.
But like any older plumbing, it's starting to show its age, especially with new tech popping up. This massive legacy system is facing some serious competition.
Exactly. So that's our mission today, to really get into this shift. We want to understand the old way SWIFT and traditional banking, its strengths, its weaknesses.
And compare that to the new kids on the block, primarily blockchain-based things like stablecoins. What are the real differences in cost, speed, risk?
And who gets impacted most? Can the banks keep up? That's what we want to unpack for you.
Okay, so let's start with the traditional setup. SWIFT correspondent banking. Why does it work the way it does, and what are the pain points?
Right. So 1973 launch, massive network, $150 trillion a year. That scale gave us reliability, which was crucial.
Absolutely. Just having a way to move money internationally was a big deal back then. But reliable doesn't always mean fast or cheap by today's standards.
Definitely not. If you look at, say, the World Bank's data from 2023, these transfers can take anywhere from 1 to 5 days to actually settle. That feels incredibly slow now.
And expensive. The average cost is often cited as $25 to $50 per transfer.
Maybe okay for a giant corporation, but for a small online seller or someone sending money home, that's a significant chunk.
It really is. And a big part of that cost and delay comes down to this idea of correspondent banks.
Explain that a bit.
Okay, imagine you're a small bank, maybe in Kenya, wanting to send money to a supplier in, say, Vietnam. Your bank probably doesn't have a direct account relationship with the Vietnamese bank.
Right.
So your bank sends the money to a big intermediary bank it does have a relationship with, maybe in London or Frankfurt. That bank might then pass it to another intermediary, maybe one closer to Asia, which then finally sends it to the recipient's bank in Vietnam.
So each step adds a fee, adds time, adds compliance checks.
Exactly. It's like a relay race where each handoff costs money and takes time. And the system, tends to hit smaller businesses and emerging markets hardest.
Like the example you gave earlier about remittances. The IMF found in 2024 sending money to Africa costs, on average, nearly 9%.
Almost 9%. When the UN goal is 3%, it shows how the current system just isn't optimized for those kinds of flows. It's literally costing people development potential.
And that inefficiency, that cost, that's the gap where these new technologies are stepping in. What brings us to stablecoins.
The main challenger, yes. So, stablecoins. They're digital currencies, usually running on a blockchain. But the key difference from Bitcoin or Ether is they're pegged to a stable asset.
Usually a major currency like the US dollar, right? Things like Tether, USDT, or USD coin, USDC. They aim to be like a digital dollar you can send around easily.
Precisely. And their big selling point for payments is speed and cost. Because they bypass those correspondent bank chains, transactions can often settle in minutes, sometimes seconds.
And the fees.
Often tiny. We're talking cents, maybe less than $1, regardless of where the money is going or how much it is. Compared to $25, $50,
It's a night and day difference, and people are using them. CoinGecko reported that Tether and USDC alone processed something like $10 trillion in transactions in 2024. That's not trivial.
No, it shows significant adoption. The underlying blockchain technology also offers a degree of transparency. Depending on the chain, you can sometimes see the flow of funds, and it enables more direct peer-to-peer transfers, fewer middlemen.
And this is having a real impact. I saw a Ripple survey from 2023, 70% of firms they talked to in the Asia-Pacific region using stablecoins said they cut payment costs by 50% or more.
50%. Imagine being an exporter in Thailand or Singapore. Cutting your cross-border payment costs in half, that's a huge competitive boost.
It really is. Which naturally leads to the question, Are banks in trouble here? Is SWIFT on the way out?
Well, it's not quite that simple. Banks aren't just, sitting idly by. They're actively adapting.
Right, they see the writing on the wall too. They're integrating this tech themselves.
Take JP Morgan's JPM coin. That's their own private blockchain system designed for instant cross-border payments between their big clients. Their own report said it was handling $1 billion a day by 2024.
$1 billion a day. So they're using the tech to get the speed benefits, but within their own regulated environment.
Exactly. And it's not just single banks. You've got major collaborations happening. The Bank for International Settlements, the BIS, kind of the central bank's bank, has Project Enbridge.
What's that about?
It's a platform using distributed ledger tech to connect central banks directly. They ran tests in 2024, settled $22 million in trades across 4 countries instantly. It's like building new, faster rails at the foundational level.
Interesting. So banks are fighting back with tech, but they also have inherent advantages, right?
Absolutely. The biggest ones are probably trust and regulation. Banks have centuries of history, deposit insurance like the FDIC in the U.S. There's a level of public and institutional confidence that's hard to replicate overnight.
And they operate under strict rules.
Yeah.
Which is important when you think about the risks with some of these newer stablecoins. Remember Terra USD in 2022?
Oh, yeah. Wiped out $40 billion practically overnight, according to Chainalysis. That kind of implosion really shakes confidence in the stability and security of some stablecoin models. Banks, for all their slowness, offer predictability.
So stablecoins promise speed and cost savings, but there's this whole other side of the coin, the risks and the regulatory piece.
Definitely. And that's a crucial part of the picture. The Financial Stability Board, which monitors global financial health, put out a report in 2024 specifically warning about stablecoin risks.
What kind of risks?
Mainly around reserves. Are they really fully backed one-to-one with actual dollars or whatever they're pegged to? The FSB found that in audits, about 10% of stablecoins showed discrepancies. That's worrying if these become systemic.
Yeah, 10% hole in reserves is not insignificant.
And the overall regulatory environment is still patchy. The OECD noted only about a quarter of countries have really comprehensive crypto laws. That leaves gaps for potential fraud, money laundering, especially in cross-border stuff.
Which contrasts sharply with banks, right? They have heavy anti-money laundering, KYC, know your customer rules.
Extremely rigorous rules. The Basel Committee found banks had like a 98% compliance rate globally in 2023. That compliance framework is a massive safeguard against illicit activity, something the stablecoin world is still grappling with building effectively across the board.
This whole dynamic plays out with really high stakes in emerging markets, doesn't it? Places where the current system is most painful, but the alternatives also carry unique considerations.
Exactly. Think about Latin America. A huge amount of their trade, maybe 60%, is settled in U.S. dollars. Converting local currency, sending dollars via SWIFT, it adds significant costs, especially for smaller firms.
So stablecoins could be a game changer there.
Potentially. An Inter-American Development Bank study in 2024 actually showed Brazilian exporters using stablecoins saw their transfer fees drop by 40%. That's money straight to their bottom line.
40% is huge,
Yeah.
But there's always a but, isn't there? What about the other things banks do?
That's the crucial counterpoint. Banks don't just move money. They provide credit. They provide trade finance letters of credit, guarantees the instruments that make complex international deals possible by managing risk.
Right. The ICC estimated that trade finance supported over $5 trillion in global trade in 2023. Stablecoins don't really offer that layer of financial services yet, do they?
Not at scale, no. So for a small business in, say, Nigeria or Vietnam, cheaper payments are great. But if they need a letter of credit to secure a large export order or financing to produce the goods in the first place, they still need a bank.
There's a risk they could get locked out of bigger deals if they rely only on stablecoins for payments and lose that broader banking relationship.
It's a real consideration. The whole ecosystem of services matters, not just the payment rail itself.
Okay, so let's try and pull this together. What's the big picture emerging from all this?
Well, it's definitely a system in flux. You've got this clear trade-off, stablecoins offering that tantalizing speed and low cost, and the volumes show people want that, passing $10 trillion last year.
But on the other side, you have the banks offering stability, regulation, and that vital credit and trade finance function that global commerce still heavily relies on.
So the most likely outcome, based on what we're seeing and what reports like McKinsey are predicting, isn't one totally replacing the other.
More like a hybrid future.
Exactly. A blend. Banks are already adopting blockchain internally. Stablecoins will likely face more regulation, which could build trust but maybe temper some of their current advantages.
That McKinsey report you mentioned from 2025 actually put a number on it, didn't it? They predicted these hybrid systems could handle maybe 20% of global trade payments by 2030.
20% is significant. It suggests coexistence, transformation, rather than outright replacement. Both systems influencing each other.
Okay, fascinating stuff. Let's switch gears now, though, and run through some of the key highlights from the markets this past week in our Stay Wired Weekly Recap.
Sounds good. Let's hit the market movers first, starting globally.
All right, what caught your eye?
Well, the European Central Bank cut rates again, for the 8th time, I believe, makes the gap with the U.S. Fed, which is still holding steady, even wider.
Interesting dynamic. What else?
NVIDIA shares actually had a decent week, surprisingly maybe, suggesting concerns about China export curbs might be fading a little. And Denmark's central bank also trimmed rates following the ECB.
We also had some trade talk noise. President Trump mentioned having a very good call with President Xi of China, focused on trade. Markets tend to react to those signals.
They do. Elsewhere, Japan saw its 30-year bond yields creep up, adding a bit more pressure on their government debt situation. And Sweden got some good news on inflation, coming in lower than expected, which boosts hopes for rate cuts there soon.
There was also that little spat involving Elon Musk and some Republicans criticizing Trump's tax plans, though it seemed to cool off, and Tesla stock actually recovered a bit later in the week.
And those Trump-Xi trade comments seem to give a lift to Chinese tech stocks specifically.
How about commodities? Oil had a bit of a turnaround?
Yeah, first weekly gain in 3 weeks. Brent was up about 2.1%. WTI crude gained a stronger 4%. Seems like a mix of factors. Optimism from the U.S.-China talks may be boosting demand hopes, ongoing U.S. sanctions on Venezuela, and just general geopolitical jitters around the Middle East.
And gold.
Gold had a pretty strong week, too, up around 2.3%, closing near $3,363 an ounce.
What drove that? More than just the trade talks.
Seems like it. The bigger factor might have been some weaker-than-expected U.S. economic data. Jobless claims, in particular, hit a 7-month high.
So that fuels speculation the Fed might have to pause rate hikes or even think about cutting sooner.
Exactly. When expectations for future interest rates ease, it makes holding a non-yielding asset like gold relatively more attractive, lowers the opportunity cost.
Makes sense. Okay, let's zoom in on Africa now. Any key developments?
A few things. Ghana saw its inflation rate slow again in May, which is positive news. And in South Africa, that big Redstone solar power project was completed by steel experts.
Wow.
Zambia's in talks to restructure a loan from Bank. South African retailer TFG reported a decent rise in annual profit. And South Africa's overall business activity, measured by the PMI index, actually hit a 4-year high. Some signs of recovery there.
But not all positive. I saw something about Bank itself.
Right. Fitch Ratings Agency actually downgraded Bank's rating, putting it just 1 step above junk status. That's a significant move.
Okay, let's hit the FX corner. How did African currencies fare against the dollar this week?
Let's see. The Ghanaian cedi, USD GHS, actually gained 0.53%, closing around 10.25. But the big story there is year-to-date, it's up over 30%, making it Africa's best performer this year.
Wow. How about the Kenyan shilling?
US to KES was pretty much flat for the week and month, holding steady at 1.900, still up a tiny 0.20% for the year.
And Nigeria. The Nairo's been volatile.
It had a strong week, actually. USD and GN appreciated sharply by 1.94%, closing near 1,557. Seems like those central bank actions and maybe better oil revenues are starting to bite. It's now only down about 1.25% year-to-date.
South African rand.
USDZR gained 0.27% this week, ending at 17.75. It's holding on to solid year-to-date gains of over 5%.
And the West African CFA franc.
USDXOF was the region's strongest performer this week, up 1.45% to 581.44. It's benefiting from the euro's strength, which it's pegged to, and good regional trade, up nearly 10% year-to-date.
Okay, shifting to the major global pairs.
The British pound, GBP/USD, continued its run, up 0.65% this week to 1.3578. Still the G10 leader year-to-date, up over 6.6%.
Canadian dollar looking strong, too.
Yeah, KBIUS gained almost 1%, 0.98%, closing at 0.7313. Helped by oil prices and in Best Weiss outlook, it's up over 4% year-to-date.
Japanese yen.
JPY/USD saw a smaller gain, 0.42% to 0.6965. Got a little help from slightly lower U.S. yields and maybe some safe haven appeal, up about 1.4% year-to-date.
Still down over 3% year-to-date, but maybe signs of finding a floor.
All right. Finally, let's touch on some individual stocks that were particularly active this week.
But first, that important disclaimer. Right. The information provided above is for informational purposes only and should not be considered as financial advice. Stock prices, ratings, and other metrics are subject to change based on market conditions. Always perform your research or consult with a financial advisor before making investment decisions. Past performance is not indicative of future results.
Okay, disclaimer done. Here are the top 7 most active stocks from our data feed this week. NVIDIA, ticker NVDA, closed at $135.13. That was actually down about 2.9% for the week. Still rated strong buy. In tech,
Right.
Lucid Group, LCID, closed at $2.23, down a fairly sharp 7.5%. Rated hold, consumer discretionary sector.
Palantir, PLTR.
Palantir Technologies, PLTR, basically flat, up just around 0.8%, closing at $131.78. Also rated hold, technology.
Ford Motor Company, F.
Ford, ticker F, also very flat, up 342% to $10.38. Rated hold, consumer discretionary.
Tesla, TSLA.
Tesla, TSLA, closed at $346.46. That was down about 3.3% for the week. Rated hold, consumer discretionary.
Apple, AAPL.
Apple, AAPL, finished slightly up, 0.05% at $207.22, rated buy in the technology sector.
And last one.
D-Wave Quantum, ticker Q, BTS, closed at $13, up just 0.06%, hold a strong buy rating, also in technology.
Okay, that wraps up the market recap. So bringing it back to our main topic today, this massive shift in cross-border payments.
Yeah, we've really seen this tension, haven't we, between the old guard SWIFT, the banks, reliable but slow and costly, and these new, fast, cheap, stablecoin alternative.
The trade-off seems pretty clear from the sources.
Yeah.
Speeding cost versus trust, regulation, and those essential add-on services like credit that banks provide.
And the likely future, as we discussed, isn't necessarily one winning out completely, but probably this hybrid model emerging. Banks using blockchains, stablecoins hopefully getting better regulated, a blend.
Which leads to a final thought, especially thinking about that explosive e-commerce growth in places like Africa and Asia we mentioned at the start.
Right.
Given how fast stablecoins and these hybrid systems are moving and how much potential they have to cut costs in those dynamic markets, how quickly can the rules, the regulations, and just the basic business trust really catch up? What does that uncertainty mean for all the small businesses there, trying to navigate this evolving landscape and compete globally? It's something to definitely keep thinking about.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.